With extensive focus on the Commonwealth budget, we shouldn't forget about the states, which collect and spend about $225 billion a year, or about 14% of GDP. This round, we think, with the slightly better economic outlook and also the Commonwealth's creative new infrastructure financing package, the state budgets could look better than they have in some time. So starting with Victoria and the Northern Territory on the 6th of May, we think that the state treasurers will be able to change their focus from how to avoid a credit rating downgrade to how to get on with the infrastructure that they'd like to build. Now, the full ramifications of the Commonwealth package are not yet known. However, what we do know is that the Commonwealth plans to pay the states about 15% of the value of the infrastructure that they would like to build, as long as that infrastructure has been funded by asset sales. It has the advantage of adding budget flexibility for the states, and it also encourages investors to buy into the brownfield infrastructure, in other words, the things that the states want to sell, rather than having the states having to pull them into greenfield infrastructure, which they're a little bit more reluctant to do. The policy also has the added bonus of being able to boost spending in the non-mining infrastructure space, which is one of the few areas of the economy that really hasn't responded very well to low interest rates from the Reserve Bank. So New South Wales and Queensland will be the two states that can potentially benefit most from this plan. The New South Wales probably has around $40 billion, we estimate, in assets that could be sold before 2021, and Queensland around $50 billion in assets. Now, the Commonwealth's greater than normal influence on the state budgets this round is also the state's greatest vulnerability. Through both general and specific purpose payments, the Commonwealth provides around 47% of all states' revenues. Therefore, if the Commonwealth chooses to fund its infrastructure carrot by taking away some of the specific purpose payments for the states, then the states could lose out, at least in relative terms. Now, the other source of potential upside for the states in this current budget round is their own source revenue. Payroll taxes are obviously largely determined by what happens in the labour market, and while we've seen very soft outcomes in the past year, we do expect these to improve, and therefore there is some potential upside here. Transfer duties, again, these have been incredibly strong, growing by around 21% in the year to December, and we wouldn't expect that growth rate to continue, but we do expect transfer duties to be reasonably strong in the year ahead. The other main source of revenue for the states is royalties, although it's really only a Western Australian and Queensland story. Now here, again, it's a bit of a wild card. Obviously, big moves in commodity prices or the currency can affect this both up and down, and quite dramatically so. But the state treasuries have put fairly conservative forecasts into their budgets on both commodity prices and the Australian dollar. Therefore, there may even be some upside if the Aussie dollar falls or you get production levels a little bit stronger. Now, for the bonds issued by state governments, semi-government bonds, it all adds up to an even greater premium. These bonds, and particularly those with tenors of less than 5 years, have been in high demand over the last few years. Since mid-2012, the gap between semi-government bonds and Commonwealth government bonds has narrowed by around 100 basis points in some cases. The demand has been boosted very much by domestic institutions, and particularly banks, ahead of the introduction of the Basel III framework. And that's because banks have to lift their holdings of Tier 1 capital, which of course includes semi-government bonds. Now, the difference in yield between bonds issued by state governments and the Commonwealth, we think, is still too high, and we think it will narrow a little bit further, and particularly for bonds with tenors of more than 5 years. Additionally, with the Commonwealth likely to increase debt and the states potentially reducing debt, and that's because of their ability to sell assets and potentially retire debt, then the supply of semis relative to Commonwealth government bonds should narrow, giving investors even more reason to buy.